We're going to take a look at some of the most popular stocks in the market right now. BigBear.ai, Archer, Tilray, and Opendoor. So let's jump right into it. First, let's take a look at BBAI. Now, this is not one we cover in Outlier, unfortunately, so I can't give you the buy and sell signals with it, but we can do some really quick analysis to learn something, right? First off, we have this big, beautiful uptrend right here, a gorgeous uptrend, but there was a huge red flag, the red light, in fact, is what I like to call these, on July 25th. Anytime you see a close under the 10, something's not as great as it used to be, right? So it had this big, beautiful trend from around $4.23. Then it closed under around $6.30, right? So about a 50% rise in this short period right here. Fantastic. Then you had several other closes under the 10 right here, right? Now you still had the 10 over 20, price over 50, but this is a red light to tell you that everything is not working the way that it used to be. And then earnings. Now, you probably had some great success in earnings not all that long ago, right? The market seemed to be really rewarding earnings, but this is the exact reason why I will not trade into earnings if I can help it. Unless I built a huge profit cushion, unless it's so far away from the moving averages. And honestly, the last time I traded earnings, it was a total fluke accident. I did not mean to. I didn't even realize earnings were happening that day. It was on Bank of America. The stock gapped up 5% the next morning. It was amazing. The market gods shone down upon me. The market gods smote down upon BigBear.ai this morning. Looking at this, this is the exact reason why I will avoid earnings at all costs. Down 31%. 31%, right? In fact, there's a very technical term in trading for when this happens. It's called being monkey hammered. Yes. BigBear.ai got big monkey hammered bigly this morning. So that is a perfect example as to why you don't want to trade through earnings. Now, you're probably one of those people. Well, let me rephrase that. If you are not a regular viewer of the channel, you look at this and you're like, well, I'll tell you what, I can't wait to buy a stock for 30% off. This is the deal of the century. Remember, stocks are an asset, not a consumable. Okay, let's talk about why we care about assets versus consumables, right? Let's say that you own a home in an up-and-coming city, and everybody's moving there, and the price of that home is going from 100,000. Now you've got several thousand more people who have moved in. The prices of the homes are going up. That home went from 100,000 to 150,000. That's great for you, right? You're buying it on the way up. They just put in a Texas Roadhouse, and as you know, that is one of my favorite real estate indicators. A Texas Roadhouse going in basically doubles the price of your home. So now it's a $300,000 home since Texas Roadhouse moved in. But imagine that you own a home that was $300,000, right? It was $300,000 a week ago. Texas Roadhouse just shut down operations there. Your value of your home just got cut in half. Okay, of course, I'm being overly simplistic here, but go with it. Texas Roadhouse just pulled out. So the value of your home is now down half, okay? And then a lot of low-income people start moving in. Those low-income people are driving up crime. And then that's pushing the value of your house down. And we're looking at this situation, and now your house is back down to 100,000, right? You could have had it on the way up and sold out on the way up as the Texas Roadhouse moved in, as everything is great. That is what an asset is supposed to do. It's supposed to go up in value. Buy it as it's going up. Not waiting for Texas Roadhouse to move out. So you're like, oh, sweet, I can grab it for half price. You grab it for 150,000. All the low-income people are moving in, pushing up crime. That's going to push down the value of your home even more. And what would have been a great investment as it was crashing up is now a horrible investment as it's crashing down. Okay, that's what's going on with assets, right? Now, let's say we're talking about consumables. This coffee mug right here, right? This incredible DuckTales coffee mug, right? Let's say you wanted to buy this, and you saw on Amazon that was down 30% for the day. You're like, yeah, of course I'll take that. Give me one of those. I want to pay less for that, because you understand that the value of this mug is never going to go up, right? The highest price it's ever going to be worth is the moment you buy it, okay? With the consumable, it will go down, and we know it will go down, and we're not kidding ourselves with that. With an asset, we don't know if it's going to go up or down. We want it to go up in value, but if we're starting off by buying it on its way down, we're starting off on the back foot, okay? So this is a perfect example of a stock you want to stay away from. At some point in the future, it could come back up, but until that point, stay away from it. Stay away from it. Now, let's go to Archer. Archer Aviation. Okay. Now, I don't know why this one's popular right now. Let's take a look at the news. Archer Aviation posted a quarterly loss of 36 cents per share. Archer Aviation has about 1.7 billion in liquidity and 6 midnight eVTOLs in production. I don't know what that means. With the analysts backing its plans to boost aircraft output and meets its 2025 UAE timeline. This is really cool. I just found this today. This little news bar right here. I like that a lot. That's going to be handy. Anyway, right? It may have analysts thinking that things are great. It may have $1.7 billion in liquidity, and it might meet its UAE timelines this year, but it certainly is not a stock that I want to own right now. Remember, this is a stock that's losing value. Now, let's objectively look at it from the Outlier 9 framework, right? Let's go start with the trend of the market. So if we look at the SPY, we do have a buy signal on the SPY. Let's jump into the SPY itself. And we can see we have a buy signal on the market. All right. So we have a buy signal and an uptrend. So I'll give you both of those. Now let's go look at market breadth this morning. Market breadth this morning is a bit conflicted, right? We had this bullish crossover here yesterday showing more and more buy signals. It's still technically crossed over today. It's really close, but it is still crossed over. But we don't have more uptrends coming through. In fact, we have more downtrends coming through. So that's not going to help out anything right here. So I'll give you a yellow or an orange, whatever you want to call it. It's a yellow light to me. I'll give you a yellow on breadth. All right. Because we do have more buy signals coming through, bullish breadth, but we're not getting more uptrends. We're actually getting more downtrends. So I'm not going to give you a full green score on that. Now let's go look at the sectors. All right. Let's go look at the sectors of these stocks. Jumping into Archer, that is this one here. This is in the industrial sector. Okay. The industrial sector has really bad breadth. Right? It's forgot to brush his teeth this morning. Really bad breadth. Right. It has less and less buy signals, and it's getting worse and worse as far as the number of stocks with uptrends versus downtrends. So you're not getting anything green from me here. Let's go look at the fear and greed too. The fear and greed on this sector is pushing further and further towards the fear, less and less towards the greed. That's not what you want, right? Remember Archer making this run back here, that buy signal, that was a huge buy signal right there. Look at the breadth. The breadth during that time was increasing. That's what we're looking for. We're not getting that. We're not getting that. We had buy signals that were growing, fear and greed that was growing, the stocks fear and greed was growing. That's what we're looking for. We don't have that today in Archer. In fact, we have quite the opposite. Right? The sector looks awful. Now let's go look at the stock. Well, it's in a red overlay, which means it's in a bearish trend. 10 is under the 20, price is under the 50. Has a sell signal here. All right, so that's terrible. That's terrible. Fear and greed getting worse by the minute, it looks like. So that's terrible. And then outlier blocks. Let's see if there's any outlier blocks. No outlier blocks in your way. I will give you that. So this is a weak sell for me all day. I don't want you coming into the market thinking when you see a stock that's down, that is a great time to buy. As we discussed earlier in the Texas Roadhouse example, you want to buy stocks as they're crashing up. Buy stocks. In fact, what a great example. We have to go back just a couple months here to May. Buy stocks as they're crashing up, not stocks as they're crashing down. And it's down, how much is it percent this morning pre-market? It's down about 5% or so pre-market. Even though it has this great, stuff coming out, earnings posted a quarterly loss, worse than analysts' expectations. Analysts forecast of 25. Well, hang on. Right. All right. Let's evaluate this real quick. Right. We're in a downtrend. We're in a sell signal. The whole sector is shitty. And then posted a quarterly loss of 36 cents per share, worse than last year's 32 cents, and analysts' forecast of 25 cents. All right. So that's bad news. However, they got over close to $2 billion in cash, it sounds like. And they're going to plan to hit their 2025 UAE timelines. So that's bullish news, I suppose. Yet the stock is not moving in that direction. Okay. So Archer Aviation is one that I would stay away from. It definitely needs a breath mint, Corey. Definitely needs a breath mint. Good one there. All right. Let's go to the next stock, right? We looked at the SPY. We looked at Archer. Now let's look at Tillray. Tillray, the weed stock. You guys remember this, right? A few years ago, this stock was on fire. This was on fire. Oh my gosh. I feel like I was on TV talking about this in 2021. I'm pretty sure I was. I've been on TV like 150 times at this point. It got old. Yeah, 2021. Yep. Yep, for sure. I was on TV talking about this one in 2021. That was crazy, right? Do you remember this one? Just gangbusters. It went from like a $6 stock to a $54 stock to as high as a $66 stock. So it nearly over 10x in a short amount of time. But just because it has a big run like that doesn't mean that it is sustainable. In fact, Mark Minervini has this rule. He says 50% of the time, a big flyer like this will fall by 80%. 80% of the time, a big flyer like this will fall by 50%. That's his 50-80 rule. Tillray was no exception to this. Now let's go look at Tillray today. There's some news coming out about today. I think Donald Trump is in the Tilray bandwagon here, because if we look at the news today, it said Tilray Brands shares surged 12% to 38.5. Surged 12% to 38.5%. I don't even know what that means. Who wrote this article? Okay. As President Trump considers reclassifying marijuana, potentially easing federal restrictions and improving funding access to cannabis firms. Bro, when did Donald Trump start toking, right? When did that start happening? But huge move yesterday. Now, granted, this is a 90, or I should say, this was a 60-cent stock for a reason. Okay. Then it was a 92-cent stock for a reason. Now it looks like it's going to be about $1.10 stock for a reason. Stocks are cheap for a reason. Stocks are expensive for a reason. I shouldn't have to justify to you. I shouldn't have to explain to you that an expensive stock is expensive because it's a good stock. A cheap stock is cheap because it's a shit stock. In fact, I want to go over to Peloton real quick. You remember Peloton, right? Yeah, Peloton is an $8 stock. But if we look back, all the way back, 2020, 2021, how much was Peloton? $170, right? That shows you that at that time, that was a great stock. That stock made a lot of sense. Today, not so much. Going back to Tillray. During the weed craze, that made a lot of sense. That was a huge move. Man, I can't even like zoom so well on this. Look at this. Huge moves. Today, not so much, right? So zooming in back into today, let's go look at Tilray and OVTLYR. If you can believe it, we actually covered it in OVTLYR. So Tilray got a buy signal a couple days ago. This is in the healthcare sector. I don't know how that happened, but it's in the healthcare sector. I own 2 stocks in the healthcare sector today, by the way. So I know that the fear and greed is rising. Is it still rising today in that sector? 50, 52, 50, 56. Yes. So fear and greed is rising in this sector. Remember, the market's not going to change. Let's go to the breadth of the sector. Still have a bullish crossover, but we're not getting more uptrends, but we are getting more downtrends. So I will give you yellow on the sector as well. Okay. Now let's go to the stock itself. Let's go to the stock itself. You got your 10 over 20, price over 50. So a bullish trend, getting way more greedy. And so that's a great start, right? You got a bullish trend, buy signal, getting way more greedy. And then any outlier blocks on top of Tilray? No, not until about $1.72. So we could put that right there. Tillray's a strong buy. Bro, look at that. Tilray is a strong buy. Now, remember, let's compare Tilray, which buys stocks as they're crashing up, versus BigBear.ai, don't buy stocks as they're crashing down. All right. This is where your money is going to be to profitability that much faster. Where BigBear.ai, it may take you months, weeks, or years to get back to break even. All right. So we looked at Tilray. Have we looked at Archer yet? Yes, we looked at Archer. Oh, yeah, there we go. Don't put your money in stocks that are crashing down. Put your money in stocks that are crashing up. Let's look at the last one of the day, Opendoor. Let's look at Opendoor. Now, Opendoor is in the real estate sector, as you can imagine. And this one had a huge move not that long ago. The buy signal came through, giant move up, huge move up. In fact, this one pegged at 100. I've never seen any fear and greed actually peg out at 100. And it certainly did. Now, we talked about it on that day. In fact, I said, what's going to happen? In fact, answer right here in the chat. What's going to happen if you are in a stock and its fear and greed is all the way pegged at 100? What can you imagine is going to happen? What can you imagine? What can you imagine? I like that one, Dr. J. Weed stocks are so high. Very good. What can you imagine? A bounce back down. Exactly. A snapback. People are going to start screaming sell. Like Kevin's saying, right? Go to 110? No, we don't have an 11 gauge, dude. A snapback. Exactly. Fear taking over. There we go. Sellers stepping in. Exactly. Which is exactly what we saw. And to Mark's point, right? 80% of stocks will experience a 50% pullback after a big move like this. How big was that pullback? Now, this is the top of that candle. It's hard to even tell just how high it was. 497. Currently, we're down 50 something percent. Pretty cool, right? I want you guys to remember the 50-80 rule. I think this is probably the first time that we've talked about it, but I want you to remember the 50-80 rule. 50-80 rule means 50% of the time, a high-flying stock like this will come down 80%. 80% of the time, a high-flying stock like this will come down at least 50%. We've shown you 2 examples of that happening. It's real, okay? But let's take a look at Opendoor. And let's go reevaluate the sector and the stock itself. Opendoor. Hey, wait a minute. News for Opendoor. 4 days ago, Opendoor Technologies cut to underperform from neutral. Oh, so we had some analyst cuts. In fact, let's go to analyst ratings over here. Oh, we got a neutral to sell. Oh, this happened a couple days ago from Citigroup right there. How about that? Neutral to sell. Okay. What else can we learn? Strategic pivot offset housing market pressures. Opendoor Technologies cut to sell from neutral. Yeah, dude. So Opendoor definitely has some headwinds against it, but let's go look at it objectively. Now, the market's not going to change, so let's go look at the real estate sector itself. At the real estate sector, well, that's not a good start. That's not a good start. It's getting way less greedy, way more fearful. That's not a great start. And then the breath is also looking bad. Somebody tell Corey to bring another breath mint for this. In fact, that's going to be a new inside joke, Corey. You got to bring the breath mints when we don't have good breath over here, okay? When we've got bad breath, bring the breath mints. I personally like Tic Tacs, the wintergreen flavor. That's my personal preference there. In fact, I don't have any in front of me right now, but I usually smash a bunch of those before church. So looking at this, right, we have more and more sell signals coming through, less and less uptrends, more and more downtrends. We need to get that breath mint. We need to get that breath mint. And we have a buy signal. So we got some conflicting data here, okay? So this is going to stay red over here. Now, a buy signal just came through Tuesday. That's today. So a buy signal came through today. It's in an uptrend right now. We can see that, all right? We can see it's in an uptrend. Fear and greed is rising, so getting more and more greedy. That's a great start. And then any outlier blocks? Oh, yeah. We got order block city right here. Outlier block city. I would not put my money at risk when I have giant levels of resistance staring me right in the face, right? That's akin to getting in your car. Let's say you get in your Tesla Model Y Performance, you smash the, it's not a gas pedal, you smash the electric pedal, and there's a brick wall straight ahead. One of the 2 things is going to happen. You're either going to smash through the brick wall and it's going to be great and you're off to Disney World, or you're going to crash in the brick wall. Everybody ends up in the hospital. I'm not willing to take that risk. Are you? I'm not willing to take that risk. So I would not be buying anything. And we're also going to use that example in the future as well. I would not be buying anything where it's staring right up into an outlier block just like that. So even though this comes in as a weak sell, this is a stay away from, right? So we covered BigBear.ai. We covered Archer. We talked about how important it is to not trade through earnings. We talked about why you don't want to be buying stocks as they're crashing down. You want to be buying stocks as they're crashing up. And even if everything is all set up for you, you could still have a ton of overhead resistance. These are sellers who are trapped, ready to get out as fast as possible. So listen, if you're ready to save time, make money, and start winning with less risk, click one of these 2 videos and have a fantastic day.